Hello and welcome to another Smaulgld live stream. It is August 21st, 2019, and tonight's topic. Fed sends conflicting messages regarding the direction of interest rates and also the possibility of QE. Now, the Fed didn't send this message today. We're going to talk about the Federal Open Market Committee meeting minutes that were released today from the July 30th, July 31st two-day meeting that the Fed had, at which they agreed to cut interest rates 0.25%. Now, I read these, and I'm going to go through these minutes with you. And there are some startling things in these minutes. It's like you've got a dozen Wizard of Oz's all in one room, talking at cross purposes. It really makes very little sense what they did. And you'll see when we go through them, and it's going to be interesting to get your reaction to them. The markets today, having, I guess, looked at them, digested them, they didn't really move the gold or silver market. The Dow Jones was up, but that always looks for an excuse to rise. There was no change, but when you see what's in these minutes, I think you'll be as astonished as I was when I read them, and we'll get to them in a second. Okay, so let's look now at, just set it up a bit, what's happening in the background. One of the things that's happening is this. You have to go back a few years. When the Fed was at zero interest rates and it had done QE, the Fed had basically almost destroyed its reputation. I don't mean amongst people who are paying attention in the gold community and hard money people. I'm just talking about in general, because it was shocking to the layperson that they went out and they bought government bonds. They went out and bought agency securities, and they brought interest rates down to zero. And they did this for like 4 years. So they ran up $4 trillion in debt, increased the balance sheet from about $800 billion to $4 trillion. And that was out of the norm. But when they stopped, the world went into full gear. Japan did it. ECB's been doing QE, has zero interest rates. A whole bunch of other central banks went fully negative, or at least went to zero interest rates, and also started massive QE. QE is bigger than the U.S. ECB is right now done over $5.5 trillion, so they've already outpaced the U.S. in QE, and they're buying corporate bonds. The Swiss National Bank is actually buying equities. They're buying stocks. The Japanese Bank of Japan owns, I think, 51% of the ETFs in Japan. So since the United States, or since the Fed stopped doing QE, the other central banks have gone bonkers. And I think this is all by design, why the Fed stopped, because it realized that if it wanted to hold on to the dollar as a reserve currency and so on, it would have to appear to be the prudent central bank. And right now, I mean, it's hard to say that the U.S. is the prudent central bank, but actually it is. It actually has raised its interest rates well over 2%. They just cut them, but no other major central bank has been able to do that. Now, that doesn't take away from the fact that the fiscal policy, monetary policy, is what the Fed and the central banks do. The fiscal policy is what the spending bodies of governments do. That would be our U.S. Congress. That's out of control, because you've got trillion-dollar deficits, you've got accumulated deficits, unfunded liabilities. So it's not like the United States doesn't have a debt problem. But the issue is it really doesn't have a Fed problem compared to the rest of the world. Okay, so having said that, I think the Fed realizes that it's put enough space between itself and the rest of the world. And while other central banks, and you will see when we get into the minutes, they're noting the fact that others are at zero, they're cutting rates, and the U.S. was on this, the Fed was on this normalization policy of raising interest rates. That can't happen, not if the rest of the world is going in the other direction. The dollar would get too strong. But I just want to before we get into the Fed minutes, just a couple of quick stories that highlight what the Fed has done. Now, here's a company called Zillow. Now, they're in real estate. Been around since 2015. 2005, haven't made a dime in their entire history, and yet, they got multi-billion-dollar market cap. Stock's done very well over the past 14, 15 years. And then they've moved into actually selling homes. They used to be like a marketing company, a consumer portal, so people can go and do real estate porn and check the price of their houses and so on. But now they're into selling houses, and according to their most recent report, they lose $3,000 in every home sold. But, don't worry, they'll make it up on volume. These are a lot of the types of companies that QE, zero interest rates, low interest rates have spawned. And Tesla's another one. We're not talking about stocks here. We're just talking about it in general. A lot of companies in the last 15 years have been able to come to market, stay in market, do secondary offerings after their IPO, continue to raise money, and act like there's no issue with them not making any money. I mean, if you were to start a business and your business was for 15 years you weren't going to make any money, that doesn't make a stitch of sense. But if your business is to boost the stock price and to sell the stock to everyone else so you can stay in business losing money, then what's the problem? And that's exactly what these companies do. So that's kind of the background of where we are, and a good portion of our economy runs on companies that don't make any money. Uber, there's tons of them. They're out there. They have multi-billion-dollar market caps, and they don't make money. Obviously, raising rates is certainly not going to help that dynamic, so they don't want to do that. So these unicorns are thriving in this low interest rate environment. And in fact, now we've seen and we've talked about negative interest rates, negative yielding debt has ballooned $5-6 trillion in the past 3 or 4 months, up to 17 trillion globally, and that's like 1 in 4, a little over 1 in 4 of all debt securities. So it's not an anomaly for a negative yielding, it should be a negative yielding bond. And now it's trickling into the deposit system, the banking deposits. Remember, a banking deposit is a deposit. You're loaning the bank money. That's what it is, but they say you're depositing the money. But anyway, let's talk about consumer banking. Well, another story here. Danish bank, Jyske Bank, will start charging wealthy clients for their deposits. And we saw Union Bank of Switzerland say the same thing. I think it was if you had over $600,000, you'd have to pay some points to the bank for them to hold your money. Credit Suisse has done the same thing. This is how it starts. This is how the income tax started in 1913. Oh, it's just for the wealthy. It's just a way of making money to pay off some stuff. Don't worry, it's not going to impact you at all. And pretty much we know what happened with the income tax. It wasn't just for the wealthy anymore. Well, this is what's going to happen. They get the rich used to paying negative bank deposit rates, and then next thing you know, it hits the average person. We've done a couple of videos on this. You can go back in the BitChute and back in the YouTube and check them out. So now we've got that environment. We got negative interest rates. We've got banks starting to test the waters with negative deposit rates. And Trump, he is not a fan of the strong dollar anymore. His response today, and you would say, well, Trump doesn't know what he's talking about, but wait till we get to the Fed minutes. You'll see they don't know what they're talking about either. But this one just factually doesn't know what he's talking about. But he's making the point. He's clued into the fact that Germany is paying zero interest rates. And this is the Fed is well aware of this. All their counterparts are at zero. And here's the Fed. They got nice leeway. They've got like 2.25 ahead of all the other banks. Some of them are negative. So Trump is saying, and is actually being paid to borrow money. While the U.S., a far stronger and more important credit, he's absolutely right there, is paying interest and just stopped, I hope, quantitative tightening. Because he's not quite sure what the minutes mean. He's not quite sure what the message he's getting from the Fed. Then he says, strongest dollar in history, very tough on exports, no inflation. Well, first of all, there is inflation. And second of all, not the strongest dollar in history. I mean, you go back even to 2003, the dollar index was about 120. You go back to the 80s, and you're at a dollar index of 165. We're not at the strongest dollar in history, but his point is taken that the dollar is strong, and it's only going to get stronger if you have aggressive fiscal policy coming out of the Fed. And also, you have the great demand for dollars in the emerging markets to pay down their debt. So the reason the Fed is cutting has nothing to do with what they're trying to do. Is they're trying to say that this is all somehow connected to their dual mandate, which is stable prices and full employment. Now watch, we're going to get into now all of that. But before, here's just another sign of the times. Trump also, against the backdrop of the United States being massively in debt, thought it might be a good idea to buy Denmark. I suppose when you're in debt and you can get a deal on something, it's better probably to spend the money and borrow money to get an asset than it is just to blow it on QE or some other program. But interesting that he made a push for it. And what I was suggesting is maybe Denmark can vendor finance the sale of Greenland to the U.S. at negative rates, because Denmark has negative rates, and then the U.S. will get paid to buy Greenland from Denmark. That's how messed up we are here. And what's interesting is people are questioning whether the United States should buy Greenland. Why would they buy Greenland? We're not going to get into the pros and cons of that. But the real issue is someone who owes, or an entity that owes hundreds of trillions of dollars shouldn't be buying anything. But again, that's just to highlight the world in which we are now here, is that this is what's going on. Now, of course, here's just the same point. Things will fall apart when Denmark vendor finances Greenland's sale to the U.S. at negative rates and pays the U.S. to take it. But we're not going to have that problem. We're not even going to have that circumstance, because today Trump tweeted out, Denmark is a very special country with incredible people. The best, huge. But based on Prime Minister Mette Frederiksen's comments that she would have no interest in discussing the purchase of Greenland, I will be postponing our meeting scheduled in 2 weeks for another time. So that's really why he wanted to talk to her, I suppose. Well, okay, that's never going to happen. So that's not going to happen. So this is where we are. Now, let's get into these Fed minutes. And I want to go through them page by page. You may think this is not going to be boring. I promise you I'll make it informative and entertaining. Maybe even Bernie can read some of it. I don't know. All right, so it starts out, and it really is very startling what's in here. Okay, so a bunch of mumbo jumbo here. The committee, I would do Janet Yellen, but she's not there anymore. They took a look at the taking stock. So there's really not much on this front page here. And they're basically patting themselves on the back of how they've steered the economy through its issues, through policy accommodation, monetary policy accommodation, which means either they've done QE or they lowered interest rates, and through forward guidance. That's what I call yak attacks. That's just them kind of telling the market what's going to happen and what's going to do, and somehow that keeps the market on an even, or the economy on an even keel. And they're saying that they're taking credit for what they think is substantial support to the economic activity in the country. And then they keep mentioning this 2% inflation rate. They act as if that's the standard. If you have 2% inflation rate, then the economy will do well. Anything under that, well, you got problems. Anything over that, well, maybe it's not a problem. So they kind of like inflation. I've never quite understood. There's not a direct correlation between economic activity and inflation. In fact, if an economy is doing really well, you can actually have deflation. We saw that in the late 19th century. You get economies of scale, you get production efficiencies, you get people buying goods and services, but there's competition, so prices go down. But I'm not here to talk about the efficacy of a 2% inflation target, but that's what the Fed has. It's as if they see a car going really fast, smoke is billowing out, and they think, oh, fast cars have smoke coming out, so they try to adjust the oil or put in bad oil to make the smoke come out, because they think that's what makes the car go faster. That's not what happens. All right, so they start out talking about how they've been the great stewards of the economy through this, nothing too startling there, other than the hubris that they think they did all this. All right, then we move on, and this really shocked me. So, they talk about the current monetary policy framework, and they're saying again, repeating themselves, it served the committee and the U.S. economy well, as if they need to serve themselves. Okay. But then, and they talk about the dual mandate, maximum employment. But here's a very, very interesting point. It's almost as if they're showing regret and remorse for not being more profligate, for not keeping rates down, for not buying more bonds that were not worth anything, for not doing more QE. And this reminds me of a saying, no one ever woke up the next morning thinking, I should have had a couple of more drinks. You know, I would have been better off if I just, had that last shot. No one thinks that. I mean, generally, if you've gone through a period of excess, doesn't have to be with drinking or anything, no one thinks, well, I should have pushed it a little further. But this is exactly what the Fed is saying here. Fresh off of printing $4.5 trillion, they are saying that through that there was non-traditional policy tools that were used, including possible adverse implication for financial stability, but this didn't happen. So, hey, we could have printed more money. We could have done, we were driving drunk, and we could have taken the airplane up drunk, because the things that were supposed to happen didn't happen. As many of the potential costs of the committee's asset purchases had failed to materialize. The Fed, here's the regret. The Federal Reserve might have been able to make use of balance sheet tools even more aggressively over the past decade. 4 trillion? 5. Why not 5 trillion? Why not 6 trillion print? Why not 7 trillion? Maybe we should have bought something else. I mean, we're doing fine. Unbelievable. They're saying they could have been even more aggressive to provide what they consider appropriate levels of accommodation, not realizing the economy does need to stand on its own feet. They don't care. They're like, well, if we can get it liquored up, we can get it liquored up even more. Then it says, however, several participants remarked, I guess these are the sober ones, that considerable uncertainties remained about the cost and efficacy of asset purchases. Yeah, you don't know the ultimate impact. So you go on a bender and you drink for a few days and you don't die. That doesn't mean you haven't caused some permanent liver damage. It's unbelievable. They say, well, we could have been more aggressive. We could have gotten drunker. Consider uncertainties about the cost and efficacies of asset purchases, and a couple of participants suggested that taking account of the uncertainties and the perceived constraints facing policy makings in the years following the recession, the committee decision on the amount of policy accommodation provided through asset allocation, and then they say, what do they say? How do they conclude that portion had been appropriate? So then some people said, yeah, we got drunk enough. Well, we probably just enough. So you had 3 points of view here, and you'll get this throughout the whole discussion. One, we should have done more, we could have done more, and we could do more, and we should do more in the future. Two, we don't know if we've done the right thing. And three, we did. We're always doing the right thing. Yeah, $4.5 trillion printed to buy bonds that nobody wanted. That's fine. All right. Now, they go on. It doesn't get any better because they've already established that they should have done more. But listen to this justification. It's as if now they've learned how to drive drunk. So we've learned a lot over the last 10 years. One, we could have done more. And two, we know how to handle our liquor. In their discussion policy tools, participants noted the experience acquired by the committee. The experience being printing up all of this money to buy mortgage-backed securities and U.S. treasuries with the use of forward guidance and asset purchase. So they learned how to blow money and then give forward guidance as to how much money they were going to blow in the future, when they were going to stop spending. And of course, they realized that we probably should have kept spending where we could have spent. We could have upped the dosage at the point when we were spending. This has led to an improved understanding of how these tools operate. So they learned how to drive drunk. They're basically saying, yeah, and we could have been drunker. We didn't go off the road. We learned how it works. And as a result, going forward, the committee could proceed more confidently and preemptively in using these tools in the future. So they're showing zero remorse for what they've done. They think it's fine. When they were doing it initially, it was like, well, this is an emergency measure. This has never happened before. You know, we're on uncharted territory here. But now it's like, oh, no, this is what we do. This is how we do it. We learned how to do it. And we want to do more of it. Because we learned how to do it more confidently. We can go more confidently. We can do it. And we don't have to wait for an emergency to just start printing money. We can preemptively use these, quote, tools because we know how this works. So now they're saying participants discuss the extent to which forward guidance and balance sheet actions could substitute for reductions in the policy rate. What are they getting at here? This is a very, very important sentence. They're saying, yeah, you know, we can only lower interest rates probably to zero. We don't have that much room, and it probably won't do that much anyway. But, you know, we could print money. We can buy a bunch of stuff, and we can buy more bonds than we did last time because, hey, we learned how to do it. We can proceed more confidently. So now they're saying is maybe we don't have to do reduce the policy rate. That would be great. I mean, from their perspective, you keep the rate higher than other central banks. That continues the demand for treasuries because they pay a positive rate of interest, while the Fed is just printing dollars and buying whatever it feels like buying to, quote, engage in forward guidance and balance sheet actions. So, this is nice. The participants looked forward to a detailed discussion over coming meetings of alternative strategies for monetary policy. And what does that mean? It means looking forward to, forget this boring stuff. Should we cut by a quarter a point? Should we keep rates the same? Should we raise rates a quarter a point? Should maybe cut rates half a point? No, that's boring. They're looking forward to alternative strategies. How much stuff can we print? How much money can we print? We're back. Yep, all the time with this. This is why I don't like YouTube. All right, I think we're back. If you guys can hear me. Yep, stream is resumed. It's a good thing I'm staring at this so I can see. So, the Fed is now back. I think we're on page 5 of this 12-pager, a 14-pager that I'm going to go through for you. So we mentioned how the participants were looking forward to discussing alternative strategies, meaning how much and what could they buy from the money that they're looking forward to printing, because now they know how to do it, they're confident about it, and they learned how to do it in the past. So it says participants expected at upcoming minutes they continue these deliberations on the review of the Federal Reserve's monetary policy strategy. Tools means printing money. They always talk about tools. QE is now a tool in your toolkit. And communication practice, meaning how to BS the rest of the world as to what they're doing. That's the Fed yak attacks. When they go out there, you see it all the time. One Fed head goes out and says, "Well, you're going to lower interest rates." Another one says, "We should be accommodative." And then someone will say, if they realize the market is getting too excited about the rate hikes, they'll trot Bullard out, or someone else will say something contrary. That's basically their communication practices, the yak attack. Okay, now these additional discussions, they're signaling very much, this is startling to me, would consider various topics such as alternative policy strategies, options for enhanced use of existing monetary policy tools. Okay, so one thing that they're allowed to do is they can print money and monetize debt. They can print dollars and buy U.S. Treasuries. They can print dollars and buy mortgage-backed securities, things that are issued by Freddie Mac, Fannie Mae, government agency debt. But then it says possible additions to the policy toolkit. What does that mean? Well, that could mean buying stuff that they're not allowed to buy yet, like corporate bonds, like stocks, like whatever they feel like doing. They're not allowed to do that right now. So they would have to go to Congress and ask for it. But of course, they might not get that green light preemptively. But you can bet your bottom fiat dollar that if there is a recession or some type of collapse or some type of stock market drop, if Powell or the Fed went to Congress and said, hey, lowering rates is not going to cut it. Buying bonds from the U.S. government's not going to cut it. We got to buy Apple stock, Zillow stock. We got to buy the unicorns. We got to buy everything. They could get that approval. And, they're going to say, oh, the other central banks are doing it. Why can't we do it? Why not? Japan's buying half the ETFs in their country. How come the Fed can't buy stocks? Buy Bitcoin. Buy whatever. Potential changes to communication practices. That's not why you would look forward to that. And the relationship between monetary policy and financial stability and the distributional effects of monetary policy. All right, so now they've clearly signaled that that's what they want to do. They want to go ahead and do more and more better QE. And then they note that, hey, everyone's doing it. Several central banks eased policy over the past month. And look at us. We've been raising rates. We're a bunch of schmoes. We shouldn't be raising rates. This is what some of the committee members are saying, but they did note it. Several central banks had eased policy over the past month, and the numbers are shifted to an easing bias. That is correct. Market participants are particularly attentive to the statement after the ECB's Governing Council meeting that was perceived as affirming expectations for further easing and additional asset purchases. So, the ECB, as we mentioned, has a bigger and larger QE program than the Fed had. It's going on longer. They're at zero interest rates, and they've already purchased $5.5 trillion worth of stuff, and they're running out of bonds to buy, but they're not going to slow down. Then it says, many survey respondents still viewed U.S.-China risk as skewed to the downside, and many desk contacts judged that the risk of a no-deal Brexit had increased. Okay. Yeah. What's next for the Fed here? So then they go on this whole... Now they've just signaled that they were looking forward to doing all this stuff. Now you get into the whole review of the economy. This is why this is very schizoid here, because they're saying they need to do all this massive stimulus, and QE, the way we did it was too small. We learned better. We could do more. We can take rates down. We can buy more stuff. But now they're saying if the information available to us at the time, market conditions, labor market is strong, GDP is fine, payroll is expanding at a solid rate, there's brisk gains and so on. So now they're telling you everything is fine. Okay? That's the staff review. Everything is fine. Then they tell you there's no inflation, which is not. That's not a good thing. You need 2% inflation. You can't have 1.4%. You can't have 1.6% inflation. You gotta have 2% inflation according to the Fed. Yes. So, but they're mentioning, again, they're below. So if they're below their target rate, that does give them their rationale based on their own rationale that they can lower rates because the inflation is not where it's needed to be. All right. Now, they then go on and talk about, okay, well, real estate's okay, even though it's gone down a bit, but also non-residential private fixed investment is also down. So now they're giving the whole yin and yang. Things are good. Well, they're not that good. Industrial production, unchanged. All right. So far, there's no reason, based on what you've heard so far, for them to have done anything. No reason to lower rates, no reason to raise rates, and certainly no reason to talk about the next time they can saddle up to the bar about keeping an open tab for a few more days. That's unbelievable that that's what they opened up with, is that's what they have to do. They learned how to booze, and they learned how to drive when drunk, and that's given them confidence that they can drive longer and they can do more stuff if they want. Then they talk about, which is interesting because this is part of the profligacy, hey, the economy's doing well because total real government purchases rose solidly. Now, government spending is not productive spending because they got to borrow to spend it. But federal defense spending increased. See, this is all good. They mentioned how the state real purchases by state and local governments also rose. Many of them are near bankruptcy, but boosted by strong gain in spending on structures and increased payrolls in those government. So, there's no reason to do anything with rates if the government's spending all the money. If fiscal policy, meaning what they spend, is doing the trick, what's the point for monetary policy? See, and they're even saying, yeah, what's with this interest rate up a little bit, up a little, down a little bit? We want to print money and buy stuff. We want to buy more than we did last time. Then they talked about the yield, and again, the yield curve. Everything from their last meeting hasn't really changed much. We hear a lot of stuff about the inverted yield curve. We've already discussed that. They didn't really discuss it. It wasn't on their mind. They're not concerned about the way they measure GDP, that there's going to be a recession upcoming. And then they mention again other countries. They got this interest rate and QE envy going on, that South Korea, Turkey, Indonesia lowered their policy rates. And hey, why are they allowed? We should be in this party too. We shouldn't just allow these other countries to do that. Then they note that actually their outlook, this is where it gets screwed up again. They say projection for U.S. economic activity, the stuff that got prepared for them, was revised up in July. So why are you lowering rates? Okay. An upward revision to household, because of an upward revision to household real disposable income in the first half of the year, led to slightly higher second half forecast for consumer spending. Remember, consumer spending is a big driver of the U.S. economy. So they're saying, hey, this looks good. It's been revised up. And the projection for real GDP growth of the medium term was stronger than we looked at last time, which means that they're not looking for a recession. They're thinking they're actually going to get a little acceleration in GDP growth. So why are you lowering interest rates? Doesn't make sense. And then it says real GDP was forecast to expand at a rate just a little bit above the staff's estimate of potential output growth in 2019 and 20. Okay. So that's what they say their projection is, but they're lowering rates. Now here's this is double talk here. I got an LOL on my own notes here. The staff continued to view the uncertainty around this projection. So for real GDP growth. They just said the real GDP growth they expect to go higher. But then they say, but the staff still judged that the risks to the forecast for real GDP growth were tilted to the downside. That's about as hedgy as you can get. You say, well, I think the stock market's going to go higher. But within that projection that I think the stock market's going to go higher, I think the risk is to the downside that my projection won't be as fulfilled on the upside as I thought. Now, if that was hard to follow, that's what they're saying. They're saying they're forecasting higher GDP, but that the staff judged the risk to that forecast is tilted to the downside. So you would think you can't make a projection and then say, but I don't really think that much of that projection. If it was tilted to the downside, then the projection itself should be lower. See how they get away with this? So well, then maybe that's the reason they got to lower interest rates, because while we think, and they're supposed to know, while we think the GDP is going to grow, we've been told by our staff that the risk for that forecast might be tilted to the downside. That is a big LOL. This is just the Wizard of Oz here. This is them just making it up as they go. I'd love to have this job. You just make it up. You go in there, you sit around, you talk, and someone writes up the minutes. But then participants continue to view a sustained expansion of economic activity, strong labor market conditions, and inflation near the committee's symmetric 2% objective as the most likely outcome. So even though everything is tilted to the downside, we think the most likely outcome is everything's going to be fine. Sustained economic expansion, strong labor market condition, and we'll hit our 2% labor target. So even if the staff thinks we're being a little optimistic, the participants, the people that are sitting at the meeting, the 10 Wizard of Oz's or 12 of them, whatever number there are, they think that's the most likely outcome. Now, to me, if you're thinking that these people don't know what they're talking about, I'm with you. I'm not following this at all. Okay, so everything's going to be fine. Economy's accelerating. Then they talk about consumer spending. They talk about the robust pace of consumer spending that's supporting the expansion, strong labor market condition, rising incomes, upbeat consumer sentiment, and yet they're lowering interest rates. Not that a quarter point's going to mean anything, but they're lowering the rate. But participants are judging that conditions remain strong with the unemployment rate near historic low levels and continued solid job gains on average. So everything is fine. Everything is just fine, but we got to lower interest rates. Now, why did they lower interest rates? It's interesting. They call it well, we're going to get to that in a second. But then they start harping again on the 2%. So if everything is fine, what do you need 2% inflation? To them, nothing is fine unless you have 2% inflation. Everything could be fine, right? If you think about it, the way they measure it, they got good GDP growth, they got low unemployment, they've got low inflation. So why do they need 2% inflation? It doesn't make a stitch of sense. All right. Regarding inflations, and they're saying, but they're still complaining we're below our symmetric 2% objective. Boo-hoo. So I guess that's a reason to lower interest rates because they can't get their inflation that they want. All right. What else do we have here? Okay. Now, they say that the downside risks to the economy that they saw in June, they've diminished. So why are they lowering interest rates? But then they said many participants noted that the recent agreement on the federal debt ceiling and budget appropriations substantially reduced near-term fiscal policy uncertainty. Okay. What they're saying here is they are giving a hard pass to Congress and saying, great job. We don't have any fiscal policy uncertainty anymore. We don't have to worry about trillion-dollar deficits. We don't have annual trillion-dollar deficits. We don't have to worry about 21, 22 accumulated deficit. We don't have to worry about 200 trillion in unfunded liabilities. We have just substantially reduced near-term fiscal policy uncertainty. How? They raised the debt ceiling. Now there's no uncertainty. Unbelievable that they would actually say that the fact that they raised the federal debt ceiling and made appropriations, well, now we don't have any near-term fiscal policy uncertainty. Everything is just fine. But the downside risk is that maybe no deal Brexit. That's not the downside risk to the U.S. economy, but that's what they say it is. And continued weakness in overall global finances or global economy may impact the U.S. economy. All right. There's still some more stunning things here. We're almost done, though. Now, there were some people that thought, based on all this gobbledygook I just read you, that they should have, I guess these were the people that wanted to do more QE when they had the chance. They could have gotten more liquored up. They wanted to lower rates, not by 0.25% at that meeting. They wanted to drop them 0.5%. So in the discussion of monetary policy decisions at this meeting, there were participants who favored a reduction in the target range of federal funds down to 1.5. Now, why did they want to do that? Well, they think that things aren't that good. They think that they need to really, really cut them down. There were two of them. They indicated they would have preferred a 0.5 basis point, a 50 basis point cut in the federal funds rate at this meeting rather than a 25% basis. They favored stronger action to better address the stubbornly low inflation rates of the last several years. So, again, these are the people that have it stuck in their craws that if you don't get 2% inflation, the Fed isn't doing its job. Doesn't matter how wonderful the economy is. You got to get that 2% inflation. So we need to lower rates. That's what these two people said. Recognizing that the apparent low sensitivity of inflation, a bunch of gibberish after that. Let's see what they got here. We're almost done. going through this. And then there were some, yeah, they thought that 0.50 wasn't enough, and they favored a stronger action to better address the stubbornly low inflation rates of the past several years and so on. So their goal is, I don't know why it's a goal, they need 2% inflation, so they wanted to lower the rates 0.5. And then there were some who wanted to just, the rent stays like before. They thought, just leave it, judging that the real economy continued to be in good place, bolstered by consumer confidence, strong job market, low rate of employment. Actually, the way they've written everything, the way they've addressed what their projections are and their assessment of the economy, whether you agree with it or not, the stuff that they threw out there basically said everything's doing well. There's really no reason to raise or lower, but still they lowered. And the fact that they're talking about, they're looking forward to having more meetings and discussing unconventional ways of printing money and spending more money because they've learned how to do it, that to me is startling. All right. Now, the other thing that was already came out in public pronouncements, but they mentioned the concept that this quarter point easing was just a mid-cycle adjustment. So it's not like, well, now we're going to start easing. That really pissed Trump off because he thought, whoa, hold on. This is what you got to do. You got to weaken the dollar. You got to get us down to like Germany to zero interest rates. And they're saying this is a mid-cycle adjustment. But I don't know. I think that there's no way they're raising rates anymore. They're talking about, they might not lower rates anymore. They may decide that, hey, we're just going to maybe lower them once more. Maybe they're not going to do zero interest rates. Maybe they'll think, like they said, might be more effective since we now know how to blow money, print money, and buy stuff. Maybe we just do that. Let all the rest of the world do negative interest rates. And then it says the overall outlook remained favorable. Significant risks and uncertainties attending the outlook remained. Well, that's always the case. In particular, sluggish U.S. business, fixed investment, and so on. So they really have no justification for what they did. The real justification to lower interest rates, other than Trump badgering them, was they don't have 2% inflation. That's probably the only, I mean, it's a foolish consistency because I don't see why they need 2% inflation, but at least they can tie their decision to that because everything else, there's no reason to have lowered the interest rates, and there's really no reason for them to talk about buying a bunch of stuff and bemoaning the fact that they didn't print enough money last time when they had a chance. All right, I think we're just about done, and we're going to take some of your comments. How did they conclude this? Read this earlier today. Okay, so let's just go through who was for it and who was against it on the committee. So 1, 2, 3, 4, 5, 6, 7, 8. So there's 10 of them. 10 Wizard of Oz's. 10 voted for it, 2 voted against it. Rosengren actually voted against it. There were people who voted for it, but there were 2 of them that voted for it, but they wanted not the quarter point cut. They wanted 0.50, and then 2 voted against it. And Rosengren was saying, look, you'll get your 2% inflation. He didn't seem to be fussed about that. And he didn't want to go any further than that. All right. Let's see what you guys are saying here in the comments. What do we got here? Got a good crew here today. All right. Philip is here. Barry is here. I don't have any comments. We got a lot of comments. We don't have any questions. All right. Ha! Mint Mark SI. Seamus says, why is it always about the drinking? I don't rightly know then, Mint Mark. Louis likes it. Why are they talking about me, Louis? Is that why you were talking about the Fed getting all liquored up? Nope, I don't think so, Seamus. It had nothing to do with you. In fact, I don't even know about it. Tossing Molotovs. There's no such thing as DWI for economists or DUI. Very interesting. All right. Okay, Pablo asks, why are the majority of the Fed members leaning to rate cut 50 basis points, 100 basis points? Not sure. They don't know. That's true. They don't know. So just keep piling on the straw until you break the camel's back, says DW. Well, that's DW. That's another good way of looking at it. What they were basically saying was, look, we got away with it last time. No problem. We printed $4.5 trillion. We could have done more. Why don't we start thinking about, now that we know how to do it, to do more? Clearly, we didn't break the camel's back then. Yeah. All right. I think that's it. That's all we got in the comments. A lot of comments, but no direct questions. So I'm going to call it a night, guys. Tomorrow we got, we'll do some more updates. We got some gold, silver, and crypto stories. Remember, I'll do Saturday night silver this weekend with Smaulgld, and I will do solid gold Sunday with Smaulgld as well. And I want to thank my Smaulgld patrons, my Smaulgld subscribers, Smaulgld.com subscribers.